A critical operational vulnerability in many growing production firms is the miscalculation of capital expenditures. When an emerging creative firm purchases a high-end cinema camera, they often record it the exact same way they record daily logistics, as a standard operating expense. But in structured corporate finance, heavy equipment is not an expense. It is institutional wealth. Welcome back to the deployment briefings for the Mohgix Financial Command System. Today, we examine Pillar 3, the Capital Assets and Depreciation Register. This ledger serves as your firm's internal valuation architecture. Observe the executive summary at the top of your screen. As you log heavy equipment acquisitions into the matrix below, the system automatically aggregates your firm's physical valuation. Currently, this dummy data reflects a total asset value of over 7.6 million naira. If your firm ever requires institutional capital, a business loan, or an investor briefing, this is the verifiable metric you present. You are no longer operating as a freelancer. You are managing a heavily capitalized production entity. However, the most strategic function of this ledger is tax optimization. Direct your attention to the total tax deduction metric. In corporate accounting, this is recognized as a capital allowance. Because this equipment was acquired to scale the business, tax authorities allow you to deduct a percentage of its value from your taxable profits annually. The MFCS is pre-coded to calculate a standard 20% year 1 depreciation rate. Look at the calculation. 1.53 million naira. By structuring your asset logs properly, you legally and accurately reduce your firm's tax liability. This ledger alone justifies the integration of the entire system. It is also vital to understand that assets extend beyond lenses and drones. Observe the highlighted entries: acoustic panels and paint for studio infrastructure, an ergonomic workstation chair, and a heavy-duty generator. Any permanent fixture acquired to stabilize or expand operations is a capital asset. Track it meticulously and leverage it for your firm's structural advantage. To maintain ledger integrity, we utilize a dual entry integration protocol. When a capital asset is acquired, you first log the outgoing capital on your core operational ledger. Immediately following that, you open this capital assets register and log the item to activate your tax optimization and generate a formalized Corporate Assets ID. Your equipment is your institutional wealth. It must be tracked with absolute precision. If you are prepared to optimize your firm's valuation, the deployment package is available via the link below. In Briefing 4, we will address unreconciled capital bleed on production sets using the micro disbursement log. We are building deliberately.